Hello viewers at home. You are welcome to my presentations on budgeting and budgetary control. In this presentation, I will explain the meaning of budget, different types of budget, and how to prepare functional budgets. Then I will as well solve questions from the past examination questions. Then please subscribe to this YouTube channel so that you will continue to receive notification each time I added another videos. Be expecting more from me in this channel from time to time. Budgeting and budgetary control. Budgeting and budgetary control. A budget is defined as a quantitative statement for a defined time, which may include planned revenues, expenses, assets, liabilities, and cash flows. A budget is defined as a quantitative statement for a defined time, which may include planned revenues, expenses, assets, liabilities, and cash flows. Budget is a financial and or a quantitative plan of operation for a forthcoming accounting period. Budget is a financial and or a quantitative plan of operation for a forthcoming accounting period. So you budget for the coming accounting period. So types of budget. Types of budget. For our purpose, I'm going to classify budget into two types. Number one is functional budget. Functional budget. And the second one is master budget. Master budget. So what do we mean by functional budget? A functional budget are budgets prepared by the departmental heads. Budgets prepared by the departmental heads is said to be the functional budget. Functional budget is a budget prepared by the head of a department. In an organization, take for instance, a manufacturing organization, there could be several departments. There could be production department. So production department will be responsible for the preparation of production budget. There could be selling department, which will prepare sales budget or revenue budget. There could be treasury department, preparing cash budget. There could be store, responsible for the preparation of material usage and material purchase budgets. So and several other departments. So the budget prepared by the head of the department is said to be the functional budget. Master budget. This is the summary of all functional budgets. The summary of all functional budgets, including the budgeted financial statement. Master budget is the summary of all functional budgets, including the budgeted financial statements. When we say budgeted financial statements, we mean the budgeted statement of profit or loss and the statement of financial position. The summary of all functional budgets, including the budgeted financial statement, is said to be the master budget. So, I've told you that functional budget is the budget prepared by the head of the department. Under the functional budget, we are going to consider the sales budget. Sales budget or revenue budget. A sales budget is a budget that incorporates the decisions about the selling price, expected sales volume, and the budgeted sales revenue for each item of product or services. A sales budget is a budget which incorporates the decisions about selling price, expected sales volume, and budgeted sales revenue for each item of product or services. Sales budget showing the selling price, the budgeted selling price, the budgeted sales volume, and the budgeted sales revenue. So the preparation of sales budget, you can have, let me give you the format. You can have products, then the sales volume, budgeted sales volume, the selling price, and the budgeted sales revenue. Revenue is the product of sales volume and the budgeted selling price. That will give you the revenue. This is in naira. This is in naira. This could be in quantity or in units. So you have product A, product B, and product C. These are the three different products the organizations are dealing in. Product A says X units. X units of product A were budgeted to be sold. The quantity of product A is budgeted to be sold is X unit. The quantity of product B budgeted to be sold is Y units. Y units of product B were budgeted to be sold for the forthcoming accounting period. And the quantity of product C budgeted to be sold is Z units. Now, the selling price of product A is M naira. The selling price of product B is N naira. And 0 naira is the selling price. Now, to get the sales revenue, we have the sales volume times the price. X times M will be XM. Y times N will be YN. Z times 0 will be ZO. When you sum it up, so we have XM plus YN plus ZO. That is the budgeted sales revenue. This is the budgeted sales revenue. When you sum it up, so that is sales budget. So that is sales budget. The second functional budget. Remember, we are on functional budget. I've told you that functional budget is a budget prepared by each department, and it is prepared by the divisional head or the departmental head. The second budget I'm going to consider is production budget. Production budget. Production budget. What do you mean by production budget? Production budget is a budget that specifies the quantity of each product to be made. The budget that specifies the quantity of each product to be made is said to be the production budget. The budget that specifies the quantity of each product to be made is said to be the functional budget. The production budget. Production budget is a budget that specifies the quantity of each product to be made. Production budget will be prepared after the preparation of sales budget. Remember, you have products. Let me give you the format for production budget. Products. We have product A, product B, and C. Then we have sales units. The budgeted sales unit, the budgeted sales volume. You start with that. The first thing you will have in your production budget is the budgeted sales volume. So the X unit, Y unit, Z unit. Everything here must be in units. 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 That is the budgeted quantity. Then after that, you add the budgeted, you add the closing inventory of finished goods. You add the closing inventory of finished goods. Add closing inventory of finished goods. You add closing inventory of finished goods for product A, product B, and product C. Please, it is the inventory of finished goods in units that will be added, not that of raw materials. It is the inventory of finished goods that will be added. So when you add it, you have this at the total. Then you now less opening inventory. Opening inventory of finished goods. Finished goods. You less the opening inventory of finished goods. When you less that, you have this. The result obtained after deducting the opening inventory of finished goods is your budgeted production. Budgeted production. This will be your budgeted production if there are no normal loss. But where there are normal loss, you add the unit in normal loss. You add normal loss. Let's assume you have normal loss for product B. So you add that. Then you have budgeted production. Budgeted production. That is production budget. Production budget. After the preparation of the production budget, the next budget I'm going to consider is material usage budget. Materials usage budget. Material usage budget, that is number 3. I'm still on functional budget. The next budget I'm going to consider under functional budget is material usage budget. Materials usage budget. Material usage budget. Material usage budget shows the expected usage or budgeted usage of materials. The quantity of material you budget to use for the forthcoming accounting period. The quantity of material you budget to use for the coming accounting period is said to be the material usage budget. So material usage budget will be budgeted usage in quantity. You'll be given the usage, or let me say standard usage. Standard usage will be given. Standard usage multiplied by the budgeted production. Standard usage multiplied by the budgeted production. You'll be given the level of usage. The budgeted production is what you have obtained above. So the result you've obtained from the production budget, and that is what we're going to have as a production budget here. Meaning that before preparing material usage budget, you will have prepared the production budget. The first one I'm going to consider is material purchase budget. Materials purchase budget. Material purchase budget. Material purchase budget is a budget specifies the expected quantities and price of each store items. A budget that shows the expected quantities. It specifies the expected quantities and price of each store items. That is material purchase budget. Now, you may have components of materials. Components of materials. Let me have component X and component Y. You start with material usage. Materials usage. The result obtained in C above. It could be in kg or other units. You now add closing inventory. Closing inventory of raw materials. You add the closing inventories of raw materials. Then you now less opening inventory of raw materials. Less opening inventory of raw materials. Less opening inventory of raw materials. So when you less the opening inventory, you have the budgeted purchase quantity. Budgeted purchase quantity. Or the budgeted quantity purchased. Then you now multiply by the standard price. The standard price of materials. You multiply by standard price of materials. It may be A naira. It may be B naira. You might have B naira for the other one. So when you multiply the standard price by the quantity purchased or budgeted purchase and quantity purchased, then you get the purchase cost. You get the budgeted purchase cost. Then let's assume what you have for component X is AX naira and component Y is BY naira. So this is the cost, AX naira and BY naira for those components. So you now add the two together. So it will be AX plus BY. This is the budgeted purchase cost. Budgeted purchase cost. That is purchase budget. Purchase budget. Then the next one is labor. Labor budget. Labor budget or labor cost budget. Labor cost budget or labor budget is a budget that shows all grades of labor, direct and indirect labor in hours and cost. A budget that shows all grades of labor, direct and indirect labor in hours and cost is said to be labor cost budget. You can have, let's assume you have skilled labor and unskilled. These are the categories of labor. Then the hours, the budgeted hours for skill, let's say is A, and that of unskilled is B. The rate per hour, let's say is A and B. So cost now, the labor cost now. So when you multiply this, A, when you multiply this, B. So when you sum it up, A plus B. This is labor cost budget. Labor cost budget. Labor cost budget. So we still have other functional budgets like cash budgets and others. So other budgets such as cash budgets, overhead budgets, capital expenditure budget shall be considered in my next lecture. So we want to give a work example. The question I'm going to solve now shall be obtained from Ezikan past examination question. Example: Abayo PLC manufacture and sells 3 sizes of extendable ladder For the use of PHCN in sizes of 3 meter, 5 meter and 10 meter. Information relating to each of these is given below. You are given standard data per unit. We have for 3 meter, we have for 5 meter and 10 meter. Selling price, we have 300, 580 and 950 naira. You are given raw material cost. Aluminium 3.5, 6, 12 meters at 20 naira per meter, and that is 70 naira, 120 naira, 240. That is the standard cost. Fixing 100, 200, 400 units at 0.1, given a standard cost of 10, 20 and 40. You have direct labor 0.1, 0.5 and 1 hours at 80 naira per hour, given us the standard cost of 40, 60 and 100. Anticipated sales volume in current year given in units, we have 20,000, 15,000 and 10,000. Anticipated inventory level at end of current year finished goods in units, we have 4,000, 2,000 and 800. You have raw materials, aluminum in total, and that is 16,000 meters. Fixing in total, that is 60,000 units. At the end of current year, management wishes inventory of both finished goods and raw material to be 25% lower than anticipated levels. 25% lower than anticipated levels at the end of current year. It is expected that sales volume next year will be 20% higher than current year for both 3 meter and 5 meter ladders, and 10% lower than the current year for 10 meter ladders. Each of the company's direct workers has a 35-hour working week for 48 weeks, with only 75% being productive, the rest being lost to sickness. Machines which are used to step and fix the ladders fix the ladders, each being capable of producing any length of ladder. So allow for maintenance and setup time. Each machine has an effective operational year of 8,000 machine hours. Abayo PLC capital budget policy demands that 2 additional such machines will be in place as from the first day of next year. Required. Prepare the following functional budgets for Abayo PLC for next year. A. Sales in units and revenue for each product and total. B. Production in units for each product. C. Material usage in meters and units for aluminum and fixing. D. Material purchases in meters and units for aluminum and fixing, along with the purchase costs for each type and total. E. Direct labor hours for budgeted output for each product and in total, plus the number of direct workers required for overall production. That is the question, then solution. The requirement A, you have to prepare the sales budget in units and revenue. And I've told you that the sales budget will be prepared by multiplying the budgeted sales volume by the anticipated selling price. Now, you were told that anticipated sales volume in current year in units. This is for the current year. You know, in year 2020, you prepare budget for 2021. And in year 2021, you prepare budget for 2022, and in that order. Since this is the current year sales volume, so this is not the volume for next year. So you look at the note. You were told that at the end of current year, management wishes inventory of both finished goods and raw materials to be 25% lower than anticipated levels at the end of the current year. That is inventory level. It is expected that sales volume next year. Now, this one focuses on the sales volume for the coming year. So that is budgeted sales volume. The clause is all about the budgeted sales volume for the 10 meter, 3 meter, 5 meter, and 10 meter ladders. You were told that it is expected that sales volume next year will be 20% higher than the current year for both 3 meter and 5 meter ladders. 20% higher. Now, you need to determine the sales volume now. So, sales volume. You have for 3 meter, you have 5 meter, and 10 meter. You were given current year sales volume. Current year sales volume is 20,000 units, 15,000 units, and 10,000 units respectively. 20,000, 15,000, and 10,000. That is the current year sales volume in units. Units. That is the sales volume in units for the current year. I have told you that you are not preparing budget for the current year. You are preparing budget for next year, for the coming year. So you go to where you have the sales adjustment. It is expected that sales volume next year will be 20% higher than the current year for both 3 meter and 5 meter. So that means if current year is 100%, the coming year, that is next year, sales volume will be 120% for 3 meter and 5 meter. That is sales adjustment. Sales adjustment. So 20% higher. That means you'll be having 120% for the next year sales volume for both 3 meter and 5 meter ladder. And 10% lower than the current year for 10 meter ladder. 10% lower. That means if the current year is 100%, the next year, if it is 10% lower, that means you subtract 10% from 100, then you'll be left with 90%. That means next year sales volume now. Next sales volume for next year now. Sales volume for next year. Next year. Calculate 120% of 20,000. 120 divided by 100 times 20,000, and that will be 24,000. The next year sales volume will be 24,000. For 5 meter, you have 15,000 times, you calculate 120% of 15,000, that will be 18,000. And for 10 meter ladder, calculate 90% of 10,000, that will give us 9,000. That is the sales volume. You have for 10 meter and 3 meter, you equally have for 5 meter, and you as well have for 10 meter ladder. Now, let's now prepare the sales budget for Abayo now. Sales budget for a buyer. So now let's have sales budget. Sales budget. You have the items. You have for 3 meter, 3 meter. You have sales volume. You have selling price. Selling price. You have the sales revenue. You have the budgeted sales revenue. So for 3 meters now, you have 24,000. That is the sales volume. For 5 meters, 5 meter ladder, you have 18,000 as sales volume. And for 10 meter ladder, 10 meter ladder, we have 9,000. 10 meter ladder, we have 9,000 as the sales volume. Then you multiply the sales volume by the anticipated selling price. So you have the selling price. The selling price, this is 300 naira, this is 580, and this is 950. So for 3 meter, we have 300 naira. The selling price, 300 naira. For 5 meter, the selling price is 580. And for 10 meter, the selling price is 950. If you multiply the sales volume by the selling price, sales volume multiplied by the selling price, that will give us 24,000 times 300, and that will give us 7.2 million. 7.2 million. Let me keep 3 zeros at the top. That will be 7,200. Then 18,000 times 580. That will give us 10,440,000, which is 10,440. Then 9,000 times 950, and that will give us 8,550,000. Now, when you sum it up, 7,200 plus 10,440 plus 8,550, then you have 26,190,000. That is the budgeted sales revenue. That is the budgeted sales revenue. That is the requirement in A. That is the requirement in A. The second requirement, requirement B. Requirement B. You want to prepare the production budget. Production budget. I've told you that to prepare production budget, you add the closing inventory of finished goods. Closing inventory of finished goods, you add it to sales unit or sales volume, then you less the opening inventory of finished goods. Then if there are abnormal loss, then you add. That will give you the budgeted production. So we have B. We want to prepare production budget. Production budget. We have 3 materials. We have 10 meter. We have 5 meter. And then we also have 3 meter. So we have sales volume, budgeted sales volume. For 3 meter, we have 24,000. For 5 meter, you have 18,000. And 10 meter, we have 9,000. That is the sales volume. Then, to this sales volume, you add the closing inventory of finished goods. Check the note. Closing inventory of finished goods. Then you were told that at the end of the current year, management wishes inventory of both finished goods and raw materials to be 25% lower than anticipated levels. That is, your closing inventory of finished goods, you were told that it will be 25% lower than the anticipated level. Lower anticipated levels at the end of the current year. So that is the closing inventory. It will be 25% lower than the inventory at the end of the current year. Now, what is the inventory at the end of the current year? Anticipated inventory level at the end of current year, you are given finished goods in units 4,000, 2,000 and 800. This is the opening inventory. I've told you that this is the current year. That one is the opening. The next year, because you are preparing budget for next year, not for the current year. So that means inventory at the end of the next year will be the closing inventory. What you have as the closing inventory this current year end will be the opening inventory at the beginning of next year. Now let's determine the closing inventory now. Closing inventory. You were given 3 meters, 5 meters, and 10 meters. You are given opening inventory. Opening inventory. You were told inventory at the end of the opening inventory is 4,000, 2,000 and 800 for finished goods. That is inventory of finished goods. We have 4,000, 2,000 and 800. Then you now have inventory adjustment. Inventory adjustment. You were told at the end of current year, management wishes inventory of both finished goods and raw material to be 25% lower. If it is 25% lower, that means if the current year inventory, if it is 100% and it is 25% lower, that means adjustment when you subtract 25 from 100. If this one is 100% and it is 25% lower, that means you subtract 25 from 100. Then this will be 75%. 75%. That is the inventory adjustment. That is 25% lower than anticipated level at the end of the current year. It is expected that sales volume next year. So that is all about sales volume. So then that means this one will be 75% again. So now let's calculate 75% now. Then to get the closing inventory. Closing inventory. 75% of 4,000. And that will give us 3,000. Then 75% of 2,000. That will as well give us 1,500 units. And 75% of 800. That will equally give us 600 units. That is closing inventory. So you add closing inventory, of finished goods. The closing inventory of finished goods, you have 3,000, 1,500 and 600. 3,000, 1,500 and 600. You add the closing inventory. When you add the closing inventory, you have 24,000 plus 3,000. That will give us 27,000. This will be 19,500. And this one will be 9,600. From the inventory you less, from this you less close opening inventory, less opening inventory of finished goods. So the opening inventory of finished goods is given to be 4,000, 2,000 and 800. 4,000, 2,000 and 800. When you less that, so this will be 23,000. This will be 17,500, and this will be 9,600 minus 800, and that will be 8,800. This is the budgeted production. Budgeted production. We have 23,000, 17,500 and 8,800. That is our budgeted production. So you want to prepare the material usage budget. Material usage budget. I've told you that material usage budget will be prepared by multiplying the usage of materials, that is the expected usage, by the number of units produced. By the budgeted production. Expected usage times the budgeted production will give you the material usage budget. We have two materials. We have fission and then we have aluminum. Aluminum and fission. Aluminum in meters and fission in units. Now, we have for 3 meters, 3 meter material, 3 meter. The production for 3 meter is 23,000. 23,000. For 5 meter, the budgeted production is 17,500. 17,500. And for 10 meter, the budgeted production is 8,800. You multiply this by the expected usage. Now, for the materials, raw material cost. Aluminum is 3.5, 6 and 12 meters. And this is the cost per unit or per meter. So, now, these are the usage for aluminum. 3.5, 6 and 12. 23,000 times 3.5, and that will give us 80,500. For 5 meter, you have 17,500 times 6, and that will give us 105,000. For 10 meters, you have 8,800 times 12, and that will give us 105,600. That is for aluminum. Then the next one is fission. Fission. Now, the usage of fission, we have 100, 200 and 400. 100, 200 and 400. For 3 meter, the production is 23,000. For 5 meter, the production is 17,500. And for 10 meter, the production is 8,800. You want to know the number of units that will be required to achieve that level of production. Now, the usage 100, 200 and 400 times 100 times 200 times 400. This will give us 2.3 million if you multiply it. 23,000 times 100, that will give us 2.3 million. 17,500 times 200, and that will give us 3.5 million. 3.5 million, that is 3,500,000. Then 8,800 times 400, and that will give us 3,520,000. So when you sum it up, you get the expected usage. Then 2.3 million plus 3.5 million plus 3,520,000. The expected usage for fizzing is 9,320,000. That of aluminum, you have 80,500 times plus 105,000 plus 105,600. That of aluminum is 291,100. 291,100. That is for aluminum. Requirement D. Material purchases in meters and units for aluminum and fizzing, along with the purchase costs for each type and total. You want to prepare material purchase budget. Material purchase budget. I've told you that to prepare the material purchase budget, you have the material usage. You have prepared the material usage, and you have for aluminum 291,100. And for fizzing, you have 9,320,000. You have the material usage plus the closing inventory of raw materials minus opening inventory of raw material. Then you have the budgeted purchase quantity. So you have aluminum, then you also have fizzing. Aluminum is in meter, while fizzing is in units. Then you start with material usage. Material usage. That is from the requirement C. And you have 291,100 for aluminum, 291,100, and you also have 9,320,000 for fizzing. 9,320,000. That is for fizzing. Then I've told you that you should add the closing inventory of finished goods. Now let's go back to the note, the additional information. At the end of next year, management wishes inventories of both finished goods and raw materials to be 25% lower than anticipated levels. That means that of finished goods and raw materials, inventory of finished goods and inventory of raw materials should be 25% lower than the anticipated levels at the end of the current year. Lower than the anticipated level at the end of the current year. Now you are given the inventory at the end of the current year to be 16,000 meters for aluminum and 60,000 units for fizzing. I've told you that the budget is for next period. So if it should be 25% lower, inventory of finished goods and raw material, you are told that it should be 25% lower. Then I've told you that percentage mean per 100. If it is 25% lower, that means you are going to subtract 25% from 100. Then you'll be left with 75%. So, meaning that closing inventory now, you have the closing inventory of raw materials. You have the closing inventory of raw materials. That of aluminum, we have the opening inventory to be 16,000. This is opening. And you have been told that the one at the end of next year should be 25% lower. That means next year inventory will be equivalent of 75%, as I've said. So if you calculate 75% of 16,000, then the closing inventory will be 12,000 units. 12,000 meters. That of phasing, the opening inventory is given to be 60,000. And if it is 25% lower, then that means you'll be having 75%. 75% of 60,000. 75% of 60,000. If you calculate 75% of 60,000, then you have 45,000. The closing inventory of phasing is 45,000 units. You add the closing inventory plus 9,320,000. 9,320,000. Then you have 9,365,000. 9,365,000. That of aluminum, you have 291,100 plus 12,000. Then you have 303,100. That is the value. Then you now less opening inventory of raw materials. Opening inventory. Don't forget, we are calculating the material purchase budget. Opening inventory of raw materials. I've told you that if it is production budget, you need the inventory of finished goods. But for material purchase budget, you need that of raw materials. Then you have 16,000 for aluminum, 16,000 for aluminum, and 60,000 for. You sum it up. You less opening inventory. 303,100 minus 16,000. Then you have 287,100. Then that of phasing, 9,365,000 minus 60,000. When you less the opening inventory of raw materials, then you have 9,305,000. This is the budgeted quantity purchased. Budgeted quantity purchased. Then you now multiply this by the standard price. Standard price of raw materials. The standard price of raw materials. Now, you have raw material costs. Aluminum is 3.5, 6, and 12 meters at 20 naira per meter. The standard price of aluminum is 20 naira. So, you now multiply this by 20 naira. That of phasing, you have phasing 100, 200, 400 units at 0.1 naira. The standard price of phasing is 0.1 naira. So if you multiply 9,305,000 by 0.1, then you have 930,500. That is the cost. That is the budgeted cost, purchase cost of phasing. That of aluminum, you have 287,100. 287,100. That of aluminum, multiply by 20 naira. 287,100 times 20. Then you have 5,742,000. When you now add the total cost, the purchase cost of aluminum and that of facing, you sum it up, plus 930,500. Then the budgeted purchase cost will be 6,672,500. That is the budgeted purchase cost. That is requirement D, material purchase budget. That is the cost. Then the next one is requirement E, direct labor hours for budgeted output for each product and in total, plus the number of direct workers required for overall production. That is the requirement E. You have to calculate the direct labor hours for budgeted output for each product and in total, plus the number of direct workers required for overall production. I've told you that to prepare the labor budget, you multiply the expected labor hours by the budgeted production. You are given direct labor 0.1 for at 0.3 meter, at 3 meter I mean 0.1, at 5 meter you have 0.5, and 10 meter you have 1.0 hours. Now you prepare labor budget, direct labor hours and manpower budget. That is the requirement E, direct labor hours and manpower budget. Direct labor hour and manpower budget. That is requirement E. You want to prepare the direct labor hours and manpower budget. Now, to prepare that, remember you have three items. You have 3 meter. I've told you that your production, you also have 5 meter and 10 meter. I've told you that your budgeted production multiplied by the hours required per unit. The budgeted production now, I mean the production budget, from our production budget, you have 23,000 for 3 meter, 23,000 for 3 meter. You have 17,500 for 5 meter, and then you equally have 8,800 for 10 meters. The hours required for 3 meter is 0.1, for 5 meter is 0.5, and for 10 meter you have 1.0. So times 0.1 times 0.5 times 1.0. So this one will give us 2,300 hours. This one 17,500 times 0.5, that will give us 8,750 hours. Then 8,800 times 1 will give us 8,000 hours. So when you sum it up, I mean this one will be 8,800 hours. So when you sum it up, then the total will be 19,850 hours. 19,850 hours. That is the hours required. Direct labor hours required. Labor hours required. From the note, you were told that each of the company's direct workers has a 35-hour working week for 48 weeks, with only 75% being productive. being productive, the rest being lost to sickness. Machines which are used to step and fix the ladders, each being capable of producing any length of ladder, so allow for maintenance and setup time. So there is lost time now. Lost time, which is 25%, because the productive time is 75%. That means the lost time will be 25%. This is the productive time, which is 75%. 19,850 is the productive time. That is the hour they actually work, and the lost time is 25%. So to calculate the 25% now, 25% out of the 75%, the total productive time multiplied by 19,850. 19,850 times 25 divided by 75, and that will give us 6,617. 6,617 approximately. So when you sum it up, plus 19,850, that will give us 467. That is the total hours. That is the total hours paid for. Total hours. The number of hours, total number of hours is 26,000. It's 26,467. That is the total number of hours. You were told each of the company direct workers has a 35-hour working week for 48 weeks. Now, how many hours now will be required? Number of hours per staff per year. Number of hours per staff. Number of hours per staff per year. How many hours? How many hours will each staff work in a year? 35 hours times 48 weeks. 48 weeks. So 35 times 48. That means each worker is expected to work for 1,680. If each worker is expected to work for 1,680, go back to the requirement. You are to determine the direct labor hours for budgeted output, and that has been calculated to be 26,467. Then you are equally asked to plus the number of direct workers required for overall production. The number of direct workers. How many staff now? Number of workers required now. If each worker is expected to work 1,680 hours, and the whole of the entire worker, if they work for 26,467 hours, how many workers will be expected to complete the task? So we have 26,467 divided by 1,680. So 26,467 divided by 1,680, and that will give us 15.75. 15.75 workers. It's not possible to have 75 workers. So that will be approximately equal to 16 workers. So number of workers now required now to be approximately 16 workers. 16 workers. So that is all about the question. So my next lecture shall cover the cash budget and other forms of